Welcome, Brian Steele from Steele Wealth Management.
And I'm Greg Weiler from Steele Wealth Management.
And today we're going to talk about the changes to the capital gains rules that were announced in the recent budget. First off, basically it was on April 16th, 2024. The main change was the change in the capital gains inclusion rate to change the taxable amount of capital gains from 50% currently to 66.67% after June 25th. This presentation, we're really going to talk about the $250,000 exemption, which is for personal. And just note as well that this does not apply to RSPs, RIFs, TFSAs, etc. It only applies to non-registered assets, cottages, rental properties, etc. So before June 25th, 2024, the inclusion rate is 50% for individuals, corporations, and trusts. And after June 24th, 2024, the capital gains inclusion rate for individuals is still 50% on the first 250,000, but any gains above 250,000, the inclusion rate is 66.67%. And for trusts and corporations, they do not have the exemption, so it's from $1 after June 24th, 2024. The inclusion rate is going to be 66.67%. How do you calculate a capital gain? Well, a capital gain is the difference between your sale price and the cost of the property. That property can be a cottage, a publicly traded security, almost anything that's sold at a gain. That results in the capital gain. How do you figure out from there the taxable capital gain? You apply the inclusion rate. So right now, the inclusion rate for everyone is 50%. So essentially, half the gain is your taxable capital gain.
The $250,000 capital gain exemption from the high rate applies to each calendar year. And it's not prorated for 24, although it really just applies after June 24th, 2024. So you'll also have a full $250,000 exemption from the high capital gains inclusion rate for each of the 2025 year, 2026, and subsequent years. Let's take an example, take a look at an example. So assume that you have $500,000 of capital gains that are realized before June 25th, 2024. So we're going to take a look at it from the individual perspective, the trust, and a corporation perspective. So on the first $500,000 of capital gains being realized, essentially, because it's just a 50% inclusion rate, the taxable component is $250,000. Assuming that you are a resident in Ontario and your marginal tax rate is the top personal income tax rate, the personal income taxes on that $250,000 of taxable capital gain would be $133,825. Trusts basically are taxed at the same tax rate as individuals, so they would also have a tax payable of $133,825. Corporations are subject to a slightly less corporate income tax rate, which yields $125,425. But you got to remember there's a level of personal tax that's also incurred to get that money out of the corporation. So again, let's assume $500,000 of capital gains are realized after June 24th, 2024, and before the year end. So for an individual realizing $500,000, the first $250,000 is going to be subject to that 50% inclusion rate. So the taxable component is $125,000. The remaining $250,000 is going to be subject to that 2/3 inclusion rate. So we're going to have $166,675 as the taxable capital gain component for a total amount of $291,675. So applying the top personal income tax rate in Ontario, the taxes are $156,134, which is basically $22,309 greater than what it was before June 25th, 2024.
So that's about 4% of the capital gain.
Yep, that's correct.
The tax is 4% additional.
So in the case of a trust where the trust actually taxes the capital gain within the trust and doesn't distribute it out to the individual, they're subject to that 2/3 inclusion rate on the first dollar. So the actual taxable capital gain is $333,350, and then the income taxes payable is $178,442. So it's $44,617 greater than what you would have paid prior to June 25th.
So that's about 9% of the total capital gain.
That's correct. And for a corporation, again, they're subject to the higher capital gains inclusion rate on the first dollar. So again, we have a taxable capital gain of $333,350, and again, corporate income taxes initially are slightly lower, but still we have an extra $41,817 of corporate income taxes payable.
Now it's time to look at some planning opportunities. We've set this up as a red light, yellow light, green light planning session, and any of this planning that needs to be done before June 25th, 2024. So on the red light planning, this really applies a lot to our clients in basic situations where they would own stock portfolios personally, or potentially in a corporation, maybe cottages as a second property, that sort of thing. So if you don't have any plans to actually sell the property at a capital gain greater than $250,000, we don't think it makes a ton of sense to do any, gain realization before June 25th, just to potentially save. It's about a 9% difference in tax rates. So we don't think it makes sense to accelerate gains on a stock portfolio if there's no other reason that you would be intending to sell that. So we put a red light on that saying status quo for people with, cottages that are going to be held for a long time, or stock portfolios that are going to be held for a long time.
In a yellow light situation, basically you're dealing with the prospect of selling a capital property with a significant gain within the next 3 to 4 years. So if you're contemplating a disposition of that capital property, it could be marketable securities, it could be a rental property, a cottage, you should review your situation. You need to calculate the future income taxes payable in the future, and then do a net present value calculation at various discount rates into today's dollars, and then compare that amount to the income taxes that would be payable if you sold it prior to June 25th or structured it during the remainder of 2024. You really need to evaluate whether you want to sell that property before June 25th or before the end of the year, or even later if you can take advantage of that $250,000 exemption amount. The other thing to consider also is the cash flow implications. You're going to be prepaying tax, so you got to have the money to pay the tax. In a green light situation, you're planning on selling that capital property in 2024. And if you can easily sell it before June 25th, do it now to benefit from the lower inclusion rate. If the capital property can't be sold before June 25th, determine if it's possible to structure the sale over the remainder of 24 and 25 to take advantage of the $250,000 exemption amount from the higher capital gains inclusion rate. If your corporation or trust holds marketable securities that are likely to be sold in the next 3 years, to rebalance the portfolio or for whatever reason, consider selling any of those marketable securities with significant capital gains before June 24th. If you have a relative or you are likely to pass away in the next few years, and if either party has capital property with a significant accrued gain, you should be considering structuring the disposition of that capital property to take advantage of the lower inclusion rate. So structure it to do the disposition before June 25th, 2024, during the period from June 25th to the end of the calendar year in 24, and in subsequent taxation years to again benefit from that $250,000 exemption from the higher inclusion rate.
So maybe an example of that would be somebody who's later in life who owns a cottage that's not going to be passed to their family.
That's a perfect example. Or another example is if you want to take some dollars out of your corporation, or you need it for another reason other than from investment, you might want to pull the trigger and basically do the disposition.
I think the one thing that we need to kind of mention here too is that we're not working with a full set of legislation yet on this, so a lot of the planning is kind of you're trying to work around with what the government has released so far, and it hasn't been a ton. So, Greg, can you just comment on what we can expect from finance, if anything, before the deadline?
That's a good question. There hasn't been much released so far. It appears that the change, this capital gains inclusion rate change, was a last minute addition, and it was not included in the draft legislation that was just recently submitted to Parliament. So we're not really sure when the actual legislation is going to come through, and that the actual legislation will give us much more detail in terms of the specifics, in terms of how it's going to be implemented. So there is some uncertainty in terms of the interpretation of these rules.
So we'll just do a wait and see on that. So thanks, everyone. We apply this level of evaluation to our clients' financial lives. If you would like a second opinion, please reach out. And thanks for listening to us today at Steele Wealth Management.